Today we're going to talk about the 5 top mistakes that most people make when investing in real estate. Mistake number 1, the property is more important than the market. Now, I see this mistake a lot. For example, there are lots of people that fall in love with properties no matter where they are. And I get this because I've seen it. For example, when the automakers in Detroit started to go down, the home prices also started to go down. As a result, many of these homes sat vacant for years. So investors were buying up small little houses in Detroit for $1,000, $5,000. And they all thought that they were getting these great deals. But the reason they did it was because, of course, the city of Detroit wanted the taxes. Point of the story is that when the market fell, the real estate was worth almost nothing. The same thing is true in the country of Sicily. When I was there recently, they were basically giving away houses. Just go Google it. You'll see many people do not want to live in Sicily, so the value of the homes are almost worthless. Now, for those of you who have ever been to Sicily, that might be hard for you to leave because Sicily is drop-dead gorgeous. But the point is, no people, no property value. The market is definitely more important than the property, and you must always understand that real estate exists for people. No people, no market, poor property values. And as major shifts in demographics continue, things like politics, taxes, affordability, work from home, crime, weather, etc., people move for these things. And as they do, markets boom and they bust. So your job as a real estate investor is to pay attention to the market, and then the property, it will do its thing. And in fact, I have an entire chapter dedicated to this one issue in my book, The ABCs of Real Estate Investing. Mistake number 2, sell when the market peaks. Now, I understand this because some people think that the equity in their real estate is some kind of hidden bank account that they can cash in at any time. What they fail to understand is that they're going to pay capital gains, oftentimes commissions, and now they're sitting in cash. The actual vehicle or the real estate that actually got you the equity is now gone, and now it's sitting in the bank or some other kind of investment vehicle. Capital gains can be attractive, but the way to harvest money out of there is through cash out refis by using good debt. Now, there's a difference between good debt and bad debt. Bad debt is buying something that depreciates over time, and good debt is something where somebody else pays you back and appreciates over time. In the case of real estate, if you buy a piece of property and have it covered with some tenant somewhere, they're actually paying down the loan for you. At the same time, you're getting the inflationary effect and the appreciation that comes along with the ownership. When you do a cash out refinance, you're actually using debt and therefore you owe it back, so it's not a taxable event, unlike selling a property where you actually owe tax. There's no question that the cash flow strategy takes longer than it would, of course, if you had a capital gain strategy, which is buy something low, sell it high, and pay tax and do it again. The problem with that is it never ends. And what we're trying to do for you is create a passive income strategy for yourself so you can be financially free forever. The best part about all of this is that the government rewards long-term housing providers with these tax breaks, and they do so in the form of cost segregations and depreciation, including bonus depreciation. So many of you know that I bought many properties this way, and in some cases, you can write off 100% of the acquisition in the first year. So imagine being able to buy something that cash flows and being able to write it off entirely in the first year legally. If you're interested in more of these strategies, feel free to pick up my latest book, The ABCs of Buying Rental Property. Mistake number 3, raising money is the hard part. False. The hardest part is actually finding the asset to buy. Raising money is actually quite simple. And to prove my point, you need to go no further than just go online, and you'll see online influencers raising capital, selling things, and they're a dime a dozen. They're all over the internet. Many people get duped into giving a lot of these folks money when they don't even know what they're doing. They don't hardly even know what they're buying. They're being used by somebody else, or they're being sponsored to sell something to you. If you're going to invest with one of these people, then what you really need to do is look for investors that have experience and know how to operate the actual business or the product that they're actually in. The biggest problem that I've seen online is where an influencer gets connected with a sponsor, they get together and they start raising capital, but they have no team. Many of the deals that they're underwriting are bad deals, but they don't necessarily care because they're raising money and they're trying to make fees. Now, the ABCs of raising capital isn't quite out yet, but it will be next year. And in this book, I'm going to talk about how you can structure your debt and equity. Whether you're buying it yourself or you're investing with somebody else, you need to know this information. Because what your cost of capital is and whether or not you're hedged in the deal can make a big difference on whether or not this property is going to perform or not perform. Mistake number 4, I will manage the property myself. False. Now, I've had this happen to me over the years. As you guys know, I started in property management, which is why I wrote the book, The ABCs of Property Management. You may have heard me tell the story about the guy who sold a building in San Diego and came to me the day before he was supposed to close on a property that he was going to buy in Phoenix. He had bought this property almost sight unseen using 1031 funds on a property that was fully occupied in San Diego and moving that money into a really bad area of Phoenix, expecting the same performance. He was initially going to manage the property himself before he realized that he wasn't going to be able to do that from his boat that he lived on in San Diego. So when he decided to turn and find a property manager, he did it on the evening before the closing. Literally knew almost nothing about the property manager as well. The reason I'm telling you the story is because many owners, many partners, and many syndicators approach property management exactly this way. They don't consider the property managers as a key part of their team before, during, or after they buy a piece of real estate. Using a property manager before for due diligence can make or break a partnership, and it can make or break all the hard work of finding something, creating value, and funding it. Property managers will find the problems before you buy the property. If you do not have any experience in this, you're actually putting your money or investors' money at risk. The second point, of course, is that lenders trust experienced property managers. On the bigger assets, lenders require third-party management or arm's length management for some of these properties because they know this is a complicated business. They know that property managers know the market, they know the numbers, and they know the people that you need either to run it or the vendors that will support it. Managing problems daily is part of the process, and that's what good property management is supposed to do. If you want to learn what you need to know to maximize your money now through property management, feel free to pick up this book. Number 5, and one of the most controversial, is using Wall Street money. False. This is often a very big mistake. What a lot of people don't quite understand is that there's a time frame on Wall Street's money, usually between 3 to 4 years. So why does this matter? It matters because the market doesn't always work in sync with the money that you borrow. There's countless scenarios where I know people that actually got money from Wall Street were in the process of growing the value of the property, and Wall Street wanted their money back before all the profits were really reaped in the asset itself. The entire financial system, as you know it, is set up to take your money and then lend it back out. And let me give you a couple examples. Think about banks. All these people put their deposits into banks. That deposit money, it's an expense for the bank. The bank now has an expense. It's paying you interest on your deposits. It becomes a liability for the bank. So the bank then, of course, has to lend it out. The same is true for pensions, retirement, and life insurance. Each time that you put money into those accounts, they are out looking for people like me to invest that money to make money for them and for you. They're using your money to make more money. That's how the system works. If you can tap into the money from Main Street instead of Wall Street, you're going to get much better pricing and much better timing so that the money that you raise is actually going to be timed perfectly for the asset that you're actually matching it with. With Wall Street, you're going to have a time frame and you're going to have a lot of pressure to perform within a certain period of time. Because as years go by with the Wall Street money, your internal rate of return or your IRR actually goes down, which is what Wall Street's trying to do, is they're trying to drive their IRRs up. Whereas with Main Street, in many cases, the investors are looking for long-term cash flow and better tax benefits to offset ordinary income. If you like some of the concepts in here, take a look at my book, The Advanced Guide to Real Estate Investing, where you're going to find that I also talk about how to manage risk with proper leverage. This is something that got a lot of people into trouble right now. The type of debt and the type of equity matters. The reason why a lot of sponsors and syndicators are in trouble today is because the type of debt, the leverage, the loan to value, and even the interest rates they got, including the equity, the different kinds of tranches, and the price of the equity cannot be paid back with the property itself. If you need advanced concepts on this, you need to pick up the book, The ABCs of Advanced Real Estate Investing.